Hey, welcome to episode 24 of the Macro Cafe. We have quite a few slides to talk about, interesting developments here in the macro world, from the dollar to the bonds to the stock market, cryptos, everything. It seems to be going nuts. Bad monthly closes, quarterly closes. There is a lot of stuff that's happening out there. We're beginning the month of October on a bearish note, we'll see how we're going to go towards the end of the year, but I'm ready to talk about this. I am your host, the Cowboy. This is Elliott Wave Cafe. Let's get started. All right, go ahead and jump on Twitter. You can find me here at Elliott Cafe. 842 followers. We keep growing. Interesting things up in there, discussions, questions, charts, stuff like that. It's I love Twitter. A very good sentiment gauge out in there. So if you want to see what's going on in the world, I guess Twitter is it's one of the best places to be and to find out, kind of what everybody thinks and what's the direction of the market overall. If you get tired of Twitter, you can also find me on Telegram here. You can see this link. This is where I spend most of my time with the subscribers. We discuss macro assets every single day. We discuss Bitcoin. We discuss altcoins. Everything that moves the markets, from commodities to Forex to, equities, stocks, everything that's interesting in there. We're trying to present, do videos every single day, and chart updates for the members. I have restarted writing for the Pigeon and the Statue. This is my Substack letter. So I wrote something last night, just to kind of get back into it. Go ahead and give that a try. This is not about Marilyn Monroe, although, there is a little piece in there about her as well. So anyway, just my thoughts overall on the market. You might find that interesting, so check that out. All right, what we're going to talk about today, it's going to be a quick macro overview, see where the markets are standing. We're going to take a look and dissect or the weeklies, the monthlies, and quarterly charts and see what they're telling us. We're going to jump on the S&P 500, Elliott Wave, and alternates, and take a look a little bit of the internals of the market. Quick chart of the Nifty 50. Then I think I want to spend a little bit of time talking about the dollar, and then some interesting charts that I think you're going to find, some value in those. So let's get going. So here is a look at the macro picture. Just a simple, large asset look. I try to go through this every single week, and I'm having this in a descending order in terms of where the RSI stands, from the strongest charts to the weakest. 10-year yields continue to act pretty strong. We have pulled back a little bit from the highs. VIX, it's also pretty strong here, hovering around 35. We have a dollar that continues to show signs of strength, although weakening here for the past few days. Then you have Bitcoin, surprisingly, that's holding up here. So on the fourth place, very nice, just kind of holding the support above 20K, followed by copper and gold. And then you have oil, you have the 20-year bonds, and then you start to go down on the equities and the Russell, NASDAQ, emerging markets and markets outside US. Then you have NASDAQ, S&P 500, the Dow Jones being the weakest overall. So most of the equities are towards the bottom in here. We have a weak market. We are breaking below the June lows. The trend seems to accelerate to the downside, but we'll see what indicators are in there that are telling us that some things are getting a little bit overstretched. But I want you to take a look and see kind of where the strength is, where the weakness is, and this kind of gives you a pretty quick view of what's happening in here. And I want to talk about some opportunities too today. I think there's quite a few in there. So let's start with the weekly charts. And what I've done again is I've done just a candle glance look at these kind of major asset classes, and I've tried to put some dots in what I think, at least in some of the charts that are showing a little bit of strength, a little bit of interesting developments in here. So you can see copper, had a pretty decent week last week with a little bit of a rally, a little bit of a pullback, but it does look like you have, a corrective move. If you go on a daily time frames, you could count this very easily as an ABC, with an impulse of these lows. And copper, it's a great indicator, a great great gauge of of kind of global demand, of economic strength or weakness, and kind of what's happening. And it's surprising to me that copper is not pushing lower at the rate that some of these stocks are telling us that we're breaking down. So copper continues to hold pretty well in here, which I'm excited about. So I would definitely continue to watch this, and especially after this kind of ABC pullback that we're getting. S&P 500 looks ugly on the on the weekly time frames. Obviously we close very bearish. You can look at the Nasdaq, full bearish close below June lows. Nasdaq Composite and Dow Jones, they all had bearish weeks. So for the past 3 weeks we've been kind of selling off relentlessly in here. Russell 2000, so small caps, mid caps in here have been holding better than the rest of the market, which is an interesting sign. So if these things are holding, which are kind of the riskiest areas of the market, then what's going on? I mean, obviously a lot of this sell-off is driven by these large caps that are starting to get hit, but the market that got hit first, it's actually not doing a lot of damage anymore. So there could be pockets of opportunities in there, which I would kind of try to search for in the Russell 2000. Then Bitcoin kind of holding steady here, just moving sideways above 20k. TLT with a little bit of a pushback. You could see in the 10-year yield also that we're after a huge advance in the yields from 250 to 75 all the way to 4. This is the first week where we're trying to reverse that and go more into a kind of a bearish look, or at least a pause in the rise in yields. I think after multiple weeks here, 1, 2, 3, 4, 5, 6, 7, 8, almost a couple of months of huge increase in yields in here is the first week that the market is kind of pausing. So I think there are some opportunities there. If you're looking at bonds, which I'll show you towards the end of the video. Then dollar index also on the weekly charts, it's got the first week that looks like a rejection from highs. It looks like an inverted hammer. I would not kind of fully categorize it as such, but it is the first move where we're actually pushed higher to new highs, and then we sold lower and closed on a bearish note. So that's why I have these dots in here, because I think these are interesting opportunities. Then also gold, has started to relax a little bit from the sell-off that it's had, and I think it's due to maybe some weakness in the dollar coming. So take a look at gold. There could be some opportunities there as well. The WTIC, I mean oil, it's still in a downtrend. I don't see much happening in here. I need to see some of these levels get taken up, and then EFA. If the dollar starts to pull back, I think we got some opportunities in these markets as well. And then VIX, it's closing off in a weekly, kind of doji in the middle of nowhere here. We're just below the 35, 38. And if you look at the, you can kind of shoot up all the way to 40 before things start to kind of get out of hand. But we're sitting just below resistance in the VIX, a place where you would be more encouraged to look at buying risk rather than selling risk at the way things are right now. Okay, on the monthly charts, things look pretty ugly. I mean, you can look at the copper again, just holding above its 200-week moving average. Not a lot of data in here. If you look couple of months back, you could see a deep rejection of the 200 of the 200-week moving average. I'm sorry, and then looking at the S&P 500. Full bearish monthly close. I mean, you can go through all of these, and some of them are even closing below those levels. So we've had a couple of months ago, we've had a nice bullish engulfing on the monthly, and that failed. And when a bullish reversal formation fails, then we have to look heavily in the opposite direction, because usually that means that the market is going to trend the other way. So let's see what's going to happen in here and how much lower this can actually travel. I'll show you the charts, but the monthly closes here are not looking at all to be exciting. And you can take this again. Maybe you can skip copper, but S&P 500, all the equities in here look pretty bad. Bitcoin continues to hold. I mean, it's been in a sideways range without doing a whole lot, just near the 20-week moving average. Maybe it's going to break with the rest of the market. So far that's holding. TLT even on the bond side, right? Just a deep bearish close in here. Then you look at the 10-year yields. The dollar with just a small blip on a reversal on the monthly time frames. Gold bouncing of the 200-week, and the rest in here I talked about. So, not a good picture, and on the monthly time frames, with the exception of, let's say, copper and gold and maybe a little bit of dollar on the monthlies. Let's go to the next one here, quarterly time frames. So these are kind of going back about 8 years, and one thing that's interesting is that on the quarterly we're showing this candle that got rejected from highs and then it closed at the lows, right? And if you think the other way, when you have more of a bullish trend and you see this kind of a candle, you call that like a hanging man. I don't know if there is a name for this type of formation. You would have wanted to close a little bit, let's say, on the bullish side to have more weight to it. But what I would like to see in here, I would like to see for the next 3 quarters, if possible. Let me just kind of draw this out. I would like to see something where the market pushes higher like that. Okay, if you can see a bullish quarter, so up until December, and a white candle that does not go, let's say, below the existing candle that's here and then reverses higher and goes back towards, let's say, 4,500 in the S&P 500, that could mean that the trend is about to resume higher. But this close here, it's not pretty at all. So, we'll see how the month of October looks like, and if there is any indication, that there could be something happening. But for right now, this looks very ugly. Bitcoin, not much to do in there, just a little bit of a pause, and overall, I could not put, the only dot I'm putting in here, it's on the dollar, because you could see how you've actually started small, on each quarter, and then you started to accelerate. But this latest candle on the quarterly, it's that explosion candle, that kind of capitulation to the upside, if we can call it that, right? Or super excitement, a lot of volume, and I'll show you some charts, and you can see this clearly on the weekly time frames. And I think the dollar is about to take a pretty big pause in here. All right, so these are the quarterly charts. Let's take a look now at the counts and see where things are standing. So the S&P 500, I've talked about this count, I think on Wednesday. So the discussion here is on the longer time frame, I'm still looking, right, as a cycle wave 1 with the cycle wave 2. Then you have a much larger primary wave 1 in here, and then looking at this correction as a wave 2 primary. Now, obviously, everybody's asking, like, hey, what is this correction finishing? What's going on? Well, so far we're still correcting. Right, it's still we're still in a let's say in a cyclical bear market against this stronger bullish uptrend, and there is no signs yet that this correction is over. There are some internals that are telling us that we're way oversold and there could be bounces coming, but there's only one scenario here that could tell us we're done, and it's still very, very premature. So we've had a massive rally into 43.25. It was a bull trap. Market got rejected out of the trend line. There was the 200-day moving average somewhere over there as well, and we could not sustain that rally. So the fact that we have broken below the June lows, right, that sends the markets into a kind of a bearish tailspin. I think the targets to the downside, at least in this, if this decline continues, are going to be obviously the highs in February before we started to sell off in COVID, and that's at about 33.93. Now, you could have a wave 2 finishing in there, and I'll show you how, and then you can start to reverse higher, or it could be wave A of the final leg of the wave 2. So you would go down in wave A, then up in B, and then down in C again to complete a second wave correction towards 3200 at about 61.8 retracement, a fib pullback from the 48.18 highs. So you can see we're starting to come below the middle trend line that I have in here. I mean, the markets have broken below that a couple of times and then reversed, so we can still give it a little bit of a chance. But the deeper we go in here, the likelihood that we're going to continue to sell off towards the bottom of this channel increase. And you could move sideways and then lower again, so it doesn't have to be a full-on flush a capitulation here or a big sell-off, but you can still kind of travel towards 3,400. So that's kind of where we are on the weekly time frames, and you can see that obviously from the candlestick patterns that's kind of what the market is suggesting. And we've had a very nasty close on on Friday. Now on the 1-day charts in here, this is kind of how this looks, and I want to talk a little bit about this. So you have the WXY, which we've looked. My videos from before, and then we wanted to see a 5-wave sequence out of this. And it started to get problematic the moment you broke below this wave 1 high. So if this was going to be a 1, 2, 3, 4, and 5, right, we could have much easier called an end to this kind of second wave correction and the beginning of a new bull market. But the markets failed apart. This trend line, I mean, obviously, you all know the fundamental behind it as well. You know what the Fed is doing. You know where we are with the interest rates and, everything like that, the liquidity withdrawal. And then the markets kind of fell apart again. And you sold off in, you had a pretty good impulse here in a big drop. Then you pull back sharply and then you drop once again. So now there's a couple of ways to think about this, right? You could have the triple correction, right? The triple zigzag. The first zigzag is a W, the second zigzag is a Y, and the third zigzag is a Z. And then you would have to count, instead of putting a wave 1 here, you would put a wave A, then you would go up in B and then down in C, and this would complete a wave Z. So the way this would be like this. So W, X, Y, X, Z, just to kind of have a visual on it, and then you start to push out of here. And you start to get, a lot more bullish if you break above 43.25, right? There's still a lot of things that need to happen. You got to have a 5-wave impulse out of here and then a little bit of a pullback. And then, you start to break above those levels. That's kind of how the market turns bullish. No evidence of this whatsoever, right? We're just kind of, working with the assumptions that the Elliott wave principle gives us here and kind of what the roadmap could be, if this pans out being, let's say, a correct interpretation. Now, if you want to stay bearish based on some of the other indicators, right, then we're continuing to look lower for a 1, 2, 3, 4, and 5, right? There's still got to be possibly a small 4th wave. I mean, this leg could be already done, 1, 2, 3 already, 1, 2, 3, 4, 5. Maybe Friday was complete, or maybe just a small low. Let's say into the beginning of the next week. Then, since this was a directional move, you can get maybe a triangle next in here in a 4th wave. So 1, 2, 3, 4, 5. And this would be a 5-wave decline now. And if it's a 5-wave decline, then it's a little bit of a problem, because that is wave A, of the next leg lower. Then you would get a B wave, and then you would get a C, and then wave Z of 2 would only complete a little bit later towards between, let's say, 3,400 and 3,200. And, I mean, if you think about 3,400 as being the high from February 2020, it's normal to expect that, that should hold at least on the first attempt here, and you could get a bounce. So maybe the market wants to travel all the way down there into this decline, and then you're probably going to get a sharp rally. With all the indicators here pointing, that we're very, very oversold, that the market, it's, there's obviously, a lot of bearishness in there. And when the boat kind of tilts that way, right, you tend to get a counter trend rally. And it could be just a simple B wave, just like this one, just like this X wave, counter trend move. If that shows up in 3 waves, then you know what's coming up next. If it starts to show more of an impulsive move, then, the story kind of changes. But this is the beauty about Elliott wave, right? Because it gives you a little bit of a roadmap, and it can catch you on the wrong foot sometime, and you might not want to see what's exactly there, but if you want to stay truthful to the market, this is kind of what's going on. And then with every single move here that the market gives us, up or down, right, we can increase or decrease our confidence in kind of this particular roadmap. So this is where we are, and I've talked in the video Wednesday also, this is a shot from that video, where there's another way that this could unfold, this correction move in a WXY, and then you get either a flat here, right? You can get a 3-3, so this is only a 3-wave move so far. You could get, right, a flat in a 3-3-5, right? That would be just like that. So A, B, and then up in C. This could become a flat of X, and then you could go down in the Z wave, right? Or you could have basically a triangle, just like it's done here, which kind of balances out this couple of corrections in here with the final move. So you go in an A, B, since it's a 3-wave move, you do like a running triangle, we call that, to the downside, because B wave came below the A, the origin of the wave A. So you have 3, 3, 3, 3, 3. Finish an X wave, you know, somewhere towards the center of this move, back towards that resistance, maybe 4,100 again or 4,000, and then sell off again, let's say in the beginning of the year. It could be, I mean, listen, the way these markets are looking right now, you know, I'm assigning a pretty decent probability that some kind of a rally is coming in here. We just don't know, right? If it's going to be a flat formation, if it's going to be a triangle, but thinking that things are getting positive towards the end of the year, right? If they want to stay choppy, they will make a triangle in here. If they wanted to stay more directional, possibly a flat, and then with the pushback up higher. So I'm a little bit discouraged kind of by the way the weekly and the monthly candles look in there, right? But I also have to be aware of kind of what's happening on the internals and kind of how this market is positioned. So that's that. I mean, this is the S&P 500. Now let me show you a couple of internals just quickly, and this is a percentage or the difference between the new highs, the new 52-week highs, let's say, in the S&P 500 and new 52-week lows. And you can see that, I mean, and we've taken, you know, we've looked at this in prior instances here where we've had rallies in the market. But if you notice here in the zoomed out part, you can see that, you know, with the new low that we're making in here, there's less issues in here that are making you 52-week low. So actually the market is moving the other way in the, you know, underneath the surface. And this is showing you, you know, right here as well, that, you know, there is, you know, that while the price would have you believe that everything kind of crashes and you want to crash, what's happening underneath the surface is that there's less issues that are selling off and they're declining, you know, versus, you know, the price in here. So, I think this is always a good indicator to kind of have a look at, right? Because you can get big divergences. The market can tell you. I mean, even on the, as you are making those highs, right? Less and less stocks were advancing, were making new 52-week highs. And it's a similar story now. Less and less stocks are making new 52-week lows. Especially if you look at the Russell, right? A lot of those stocks have already been killed that, you know, they really can't send them much lower. You know, most of the damage that's been happening here over the past, let's say, couple of weeks has been done by the large caps, right? You can see what's going on with Apple and, you know, maybe Amazon and Microsoft and you know, Nvidia. So a lot of these stocks are kind of getting hit on the technical side. So, but take a look at the breadth indicators and study those, and, you know, this kind of shows you kind of what's happening underneath the surface. So it's very, very tough to get ultra bearish, you know, at this moment. Here is what's going on the bullish percent index, and this is the one that I've talked about on Wednesday as well. I just zoomed it out a little bit more to kind of capture more data going back to 2013. And, you know, I can't help but notice, I mean, I cannot ignore, you know, how oversold we are on the bullish percent index. And this refers to the, you know, point and figure charts and all. But, I mean, all the instances here where we've touched you know, let's say near 10 on the bullish percent index, you know, they were followed by massive rallies. I mean, this was an outlier event, obviously, during the COVID lows, and it went down to below 5. Last time we were near 10, it was in, you know, the end of 2018. You remember when Fed started to increase rates and then they pivoted. And, you know, it was followed by a massive rally. And, you know, a couple of instances here when we went down to 25 in 2015, 2016, right, that led to, you know, pretty decent reversal. And then, you know, I would have to go back all the way to 2008, when you had the massive market crash where this indicator actually went down, then up, and then down, and it kind of stayed depressed for a longer time, which could happen, you know, even now. But I don't know. I think the chances of a bounce here are increasing. By this showing you like how oversold we are and kind of what's going on in here. So, again, it's very hard, even though, again, those weekly and monthly charts are showing you that the market is trending lower. We have to pay attention to these because snapbacks could be very, very furious. So, I wanted to show you that. Okay, a quick look at India 50. I talked about it, I think, last week or a couple of weeks ago. Maybe I posted some charts on Twitter. But interesting developments here because this market, it's doing pretty well. I mean, taking in consideration what's happening in the equities here in the United States, the Indian stock market, it's holding pretty well. And it had a decent correction here, ABC for the W, then up in X, and then down in Y. In what I think it could be a second wave. Now, if this is not done, I mean, this is, it's almost textbook complex correction in here. It could be a very simple WXY, XZ, because those are mostly, they're not as directional, right? As you can see in the S&P 500, this correction is very deep, kind of, and directional, the angle of descent, and this one is more sideways. So a couple of things that can happen in here. You could actually be done right into these levels near 15,000, and then this could be an impulsive move, 1, 2, 3, 4, 5. Now you're doing the first wave of the decline. 1, 2, 3, 4, 5 may be done already, then up in a rally in B wave, then down in C to complete a second wave, right? Or if this is an alternate X wave, then you're going to do, let's say, another ABC for a wave Z, which would still push you higher, let's say, after this year is finished, maybe towards the middle of the next year, who knows, but, depending on kind of how long this takes. But both of these are fairly bullish to me. So, it's something that I'm definitely watching. Now, if you're coming below these levels, I think that something else is going on, and you could start to get to a much deeper decline in the Indian stock market. But if you stay above, this support, I would call it, put a line in here, somewhere like there, like between 15.5 and 16K. If you manage to stay above those levels, I think things could continue to look pretty bullish. If you start to break below, then this could be a massive failure, and you can continue to kind of drop below 14K. But so far, this market looks good and interesting. And I wanted to take a second to talk about these X waves and these B waves. I mean, look what impulsive characteristics they have, right? They would have you believe that this is actually an impulsive move, and you would be tempted to buy against such an impulse, right? And it's, lately I see more and more of this happening, right? These corrections are pretty steep and pretty impulsive looking, and all they are, look like they're B wave and X wave. That's why they are the fool's rallies, right? That's why these are bull traps. So always keep in mind, just because, you can see a 5-wave advance in there, you're supposed to trust it, but you're not really supposed to trust anything in this market, right? So no matter what methodology you're using, you kind of have to be careful with any impulse to the upside. Just because it looks like one, it doesn't have to be one. And you need, let's say a better confirmation. You need, a proper 3-way setback and then a return and a break above it, right? To start to confirm that that's the case. So for example, in here, if you had a 5-wave move, that's fine. Then how does this look, right? Does this look like this? And you're starting to break back. If you're starting to break back, then, then you start to get excited. But just because this is, giving you an impulse and jumping on the bullish side because of that, this is pure examples of how these, impulsive looking moves can actually fall apart. So just throwing that out there for you guys. Okay, the next one, I'm going to talk a little bit about the dollar. Okay, and listen, in my view, and I've been talking about this, I was wrong because I thought that the top was back in here, right? Because you've had this, interesting, also kind of bearish reversal formation, and the market kind of went back up higher. But, look at the volume in here, guys. And the next chart, I'll show you the trend lines as well. And this is, I think, a chart from Twitter that I just posted a couple of days ago. Huge volume on the UUP, Bullish Index Fund. Massive reversal out of those levels. I don't know. It looks to me like, this was an explosion, and just everybody got excited about the dollar. That's why you've had such an let's say an influx of funds in there possibly through this volume, and then they kind of turn on you. So it's a first signal that the dollar, it's probably running into some heavy headwinds in here, and it's probably, I'm not saying you're going to get a huge reversal. It's possible, but at least a pause in here and some kind of a correction happening in the dollar. I mean, this is what this is telling me. Look at the Bloomberg Business Week cover that just, I think, came out a couple of days ago for October 3rd. And I mean, what does it say here? Can't stop, won't stop. Who? The dollar. The Fed has turned the US dollar into a wrecking ball, and there is no end in sight to the carnage. Listen to these guys. Bloomberg Business Week. I mean, who in the world is writing this shit? The Fed has turned the US dollar into a wrecking ball, and there is no end in sight to the carnage. There is no end in sight. 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 I think the end is in sight. I think the end is very near. So we're going to be looking back at this cover maybe 6 months from now and see kind of where the dollar is. Let's give it 6 months. Let's give it 3 months. Okay. Trend line, just a copy of the channel, top of the channel. There is no end in sight after you've had, I mean, look at this rally in here, right? Yeah, you can still grind higher a little bit, but what rate? Probably a little bit of a, let's say maybe a triangle in here with another push higher. But listen, the end is here. It's not, no end in sight. I'm just losing my mind. So anyway, magazine covers here kind of telling you what's going on, right? And if you read my article on Substack, I talked about the natural gas, I talked about the energy. So similar stories have happened in those markets as well. There is no end. The Europe is going down, and this and that and the other, and then those energy markets are collapsing, because there is no end in sight. Of course, it's easy to write this article when the dollar is at these all-time highs, because that's kind of what sells. But this is kind of where we are. I wanted to show you also the euro dollar, and I posted this on Twitter. Big impulse move out of here. Let's say 2001 to 2008, dollar got wrecked 1, 2, 3, 4, 5 for a pretty good impulse higher. Then it started to correct, and this is what happens in corrections, right? They start and then they never end. And the euro, I mean, you could have thought that maybe this correction was over right here, and it wasn't, right? Because it was very nice ABC, and the markets kind of struggled to rally. You could have thought that this was a wave 1 and this was a wave 2, and then you're starting to move higher. No, they failed. They never took over this X wave, and then they fall apart again at the trend line. So the market's just sold off. Now I'm trying to connect these through an A triangle, B down in C for the wave W, ABC for the wave X, then another A, B, and then down in C. We're sitting at about 78.6 fib of this retrace from here to here, and that's on a log chart. The arithmetic chart is fairly close. Also, we're up near the top of these levels right from 2001. We're very close to this channel in here. I mean, back here looks a little bit better. So, I mean, you can be super precise on these things, but the rejection that we've had from the lows, what happened with the Bank of England, what's going on with the pound, again, the business cover news and all this talk about the dollar going to 140, 150, I think it's a crazy talk. And, I think this is when you start to pay attention to these markets. Now, obviously, no super confirmation just yet, but I'm willing to kind of bet and put money on this trade on the euro long side and short dollars because, there's a lot of evidence here of this trying to reverse out of here. So that's kind of what I wanted to show you. It could be a period of, if this is done, right, and if it's just a simple ABC, you're looking at a period of dollar weakness for the next 10 years. Okay, so that's kind of what I'm thinking. Could it be a little bit more weakness? Sure. Could you drop back towards 90 cents? Maybe the sequence is not fully complete. There's a 1, 2, 3. Maybe there's a triangle in a fourth wave. But again, right, you're towards the end of this move. You're very much towards the end of this move, right? It doesn't have to happen tomorrow, but that's kind of how positioning starts, and that's what's going on in the euro dollar. Look at the British pound, and I can't help by notice this, and I cannot ignore it. The British pound has been in a big heavy decline for many years. You're almost reaching parity with it. But I mean, look at this candle. Look at the bounce, and maybe you can say that this was because the Bank of England kind of stepped in and started to buy bonds and all of that. But you combine that with the top in the dollar, and you're looking at this kind of huge hammer here on the weekly time frames, and this is telling you that being bearish British pound here, it's probably a big problem. So or it's probably going to lose you money. I don't know. Maybe there will be a little bit of a retracement back towards 110, 108, but this is a huge signal on the bullish side for the British pound as well. I mean, you had a pretty big, bullish engulfing here, right? This was the COVID lows and then rally, and then you're coming back lower and you're creating this after, one of the biggest sell-off in its history is in here. Pay attention to British pound. A couple of charts here towards the end I wanted to show you, because this is another interesting development in here. So you can look, this is the VDI, it's the total stock market ETF, and then we're dividing that with the bond ETF, the aggregate bond ETF, AGG, and you can see how the ratio starts to be in favor. I mean, it's already been in favor of bonds versus stocks, let's say starting at the beginning of the year, February, March. So they both dropped, right? But it seems that the bonds here are taking a little bit of a they're coming towards the front, and it's something that's outperforming, starts to outperform the markets overall. So I'm looking to accumulate bonds in here. I think they're interesting levels with interest rates being where they are. I don't want to get into the whole story about Fed reaching, let's say, peak rate hikes, which it's very possible that by December we could be done, or early next year. But there's a lot of interest in these bonds right now at these yields, so this ratio kind of shows you that. And then also look at the ratio between the TIPS, the Treasury inflation protection securities, and the regular bonds. So they're dumping those and picking up regular bonds, and this is what's showing you what's happening with the inflation. That's how the market is telling you that they want to get out of this inflation protection and move to to government bonds in here. I mean, huge rally since April 2020, up to 113 on this ratio, and huge move higher out of a triangle. You're done. You're starting to correct lower. So again, pay attention to long-term bonds in here, because they could be very interesting. And then this is the investment-grade corporate bonds. I mean, look at the volume as we were finishing up this week's full capitulation in this trade. People, we're going crazy about losing money even in bonds because they're supposed to be so safe. And I can see a third wave in here. I see a fourth wave. I see a fifth wave. I don't have to, to put labels in here, but it is pretty clear to me that this trade is running its course and it's pausing and it's probably going to start to reverse. So LQD, they pay you pretty good interest as well. So just a investment grade bond in here, but all the bonds are starting to look quite attractive in here. Guys, listen, thank you for watching, and don't forget to subscribe and like always. Visit me in the pro room, visit me on Twitter, check out my Substack, leave your comments, opinions, suggestions, anything you got. Get in touch with me, and again, I'm happy to have you. We're about 100 subscribers shy of 5,000 subscribers for YouTube, and I like that. I appreciate every single one of you, and thank you for sticking with me and my ramblings in here. All right, talk to you later. Bye-bye.